The topic we're covering today is rent seeking, but not the traditional government enterprise aspect. Instead, we'd like to bring you to a whole new form that is now taking place in Wall Street, the epicenter of modern financial world. We'd like to first introduce Daniel, a young Wall Street equity trader at Vanguard, which is a renowned mutual fund in the US, and Jack, a data scientist operating his own high-frequency trading firm. Since the late 2000s, Daniel found out that every time he places an order to purchase a stock, for example, 100,000 shares of Apple at market price he saw on his screen, say $100, he could only buy a portion of his 100,000 shares and to purchase the rest of the shares at a price that is a little higher than just a second before. This has happened numerous times and eventually made him suspicious of this abnormal situation. The situation was becoming a serious problem for equity traders because their execution price was higher by a fraction every time they trade, and the difference in price could mount up to millions, if not billions annually. The main causes behind the whole problem are front-running, high-frequency trading, and how trades are executed today. We'll explain in detail how it links to our topic today. The mechanism behind this is different from conventional rent seeking, where business enterprises pay government authorities to create profitable opportunities that is ultimately damaging to society. In this context, high-frequency trading firms pay exchanges such as NASDAQ and New York Stock Exchange huge sum of fees to acquire information, which we define this as information rent seeking. To explain this phenomenon, note that there are currently 13 stock exchanges in the US. When someone places a buy order on their screen, the trading signal will be sent to the trading processor of the nearest exchange to buy the stock. In the case of Daniel, the 100,000 share order will be first sent to the exchange in New Jersey, which is right across the Hudson River. When there are not enough shares in the New Jersey exchange to cover it, the rest of the order will be sent to other exchanges in different locations. High-frequency traders like Jack saw an opportunity behind this process. They intercept these signals through priority access to trade information and run ahead to other exchanges to sweep available stocks, which they could eventually resell at a higher price than before. This practice is also known as front-running. In short, exchanges enable HFT firms to run ahead and observe market activities by providing faster data access and location advantages, also known as cold location, which refers to the practice of traders placing their trading computers in the same data center that houses an exchange servers, allowing these firms to extract information from patterns of trade by algorithms. To make an analogy for this process, consider Daniel is an experienced weather forecaster who can accurately predict weathers. Through his research and scientific knowledge, he could buy an umbrella to avoid getting wet. If Jack could observe Daniel's decision to buy the umbrella and the price he intends to pay, he knows that it is going to rain and could run to the store to buy the umbrella. By running ahead and buying all the umbrellas, Jack can eventually resell all those umbrellas to Daniel at a higher price. In this analogy, umbrella represents stocks and the weather condition represents the reward. Conventional investors such as mutual funds, pension funds, and etc. spent resources and invested in real economy by hiring experts, conducting macro, industrial, and equity research to produce important intelligence, knowledge, and information that foster market efficiency. On the other hand, high-frequency traders profit from at the expense of investors without creating any real output. The benefit high-frequency trading creates is far less than the cost associated with it, and the costs are usually borne by the public. In its IPO prospectus, high-frequency trading firm Virtu revealed that it had only one losing trading day in 1,238 days of trading. Is it because there are better investors, or are there any other hidden reasons behind it? It is up to you to decide. Many high-frequency traders claim that HFT is socially beneficial by providing liquidity, facilitating price discovery, and narrowing bid-ask spread and ultimately increasing the market efficiency. However, the cost, such as flash crash, quote stuffing, and dozens of unnecessary infrastructures associated with HFT, clearly outweighs the benefits. In addition, we are skeptical about whether these so-called benefits even exist in the market. Flash crash is when market goes off a cliff in a short period of time. In May 6, 2010, Dow Jones plunged around 1,000 points in 10 minutes due to the domino effect of high-frequency trading. It was the worst point drop ever in Dow history, and it is reported by Bloomberg that investors saw $1 trillion of value erased from US financial market in just few minutes. Quote stuffing is when traders placing unusual numbers of buy or sell orders on a particular security and then immediately canceling them. In this picture, the blue lines represent volume of fake quotes, and the orange lines are the actual volume that's being traded. This can create confusions and artificial liquidity in the market and trading opportunities for algorithmic traders. As for unnecessary infrastructures, American investor James Barksdale invested $300 million in fiber optic cable to increase the connection speed for just 3 milliseconds for the exclusive use of faster data transfer from New York to Chicago, which could otherwise be invested elsewhere. The disruption caused by high-frequency trading has further led to the creation of dark pools, a form of private exchanges hosted by megabanks like Citi, UBS, for institutional traders to trade large blocks of shares and protecting them from skimmed by HFTs. The volume of equity traded in dark pools account for about 14% of US equity volume. The emergence of dark pools has further undermined the efficiency and functionality of public exchanges, leading to a non-transparent market. These actions and consequences are not only social wastes, but also costing the society in lots of forms, including increased volatility in the market. Investments by HFT are not based on value, but rather a form of arbitraging executed through speed by using valuable resources unproductively. It ultimately damages the functions of exchanges as the medium of efficient capital allocation and the foundation of equity market. But there are also market solutions to such rent-seeking activities. Research have shown that the average return from such information rents has been decreasing these years, possibly due to increased competition. We call it complete dissipation theorem, meaning the effort expended by everyone chasing the value wipes out the value they are chasing. Thank you very much.